is the biggest crash in all markets since 2009 getting ready to happen. Stock markets, real estate, bond market, everything, the everything bubble crash. Let's jump in, take a look at what is going on. There's a lot of stuff happening out there today. Jamie Dimon came out, JP Morgan chief, says that this is serious. He warns that the US is likely to tip into a recession in the next 6 to 9 months. He is warning that the U.S. economy is actually still doing, he says that the economy is still doing well. Consumer balance sheets are strong, although consumer credit is going up. At present, and consumers were likely to be in better shape compared to 2008 global financial crisis. But you can't talk about the economy without talking about stuff in the future, and this is serious stuff. His comments come at a time of growing concern of the prospects of an economic recession as the Federal Reserve and other major banks raise interest rates and continue to raise the chances of a 75 point basis, another 75 basis point rate hike in November is still, the chances of that are going up every day because of inflation. We're going to find out Thursday what that looks like. If we get a hot CPI again, markets will likely continue their trend down. If we get a good CPI, inflation dropping, markets will rip a little bit, and they already popped a little bit today a couple of times because of Fed speakers out there hinting even slightly at some sort of a dovish pivot kind of a thing. But one of the biggest things that Jamie Dimon was talking about, he said these are very, very serious things, which I think are likely to push the U.S. and the world. I mean, Europe is already in a recession, and it's likely to put the U.S. in some sort of a recession 6 to 9 months from now. He also said that his most concerning thing that is the most serious is the war. He's more concerned about the war than any other economic condition right now. It can go from very mild to quite hard, and a lot will be relying on what happens with this war. So I guess it's hard to be prepared in that regard. And on other news, we have the Fed's Evans out today, who's saying that fighting inflation is the top priority. So the Fed speakers are still coming out united in a united front that they are first and foremost after inflation. They're going to get that down because that's doing more damage to the average consumer, the average citizen in the United States than anything else. And ARC's Kathy Woods has issued an open letter to the Fed. Kathy is in desperation mode now. Her fund is under pressure, has been under pressure. She bought back at the all-time highs, and she's issued an open letter to the Fed talking about their analysis is wrong, that they should not be unanimous and united in their fight against inflation. And she's pointing out how the data-driven Fed is not considering commodity prices. So she's pointing out commodity prices that, again, she's saying that inflationary pressures are down. The Fed's looking at the wrong indicators. She's in the transitory camp. She's saying the Fed's trying to affect supply chain with interest rate hikes by destroying demand. But what she's leaving out is one of the biggest factors of inflation, which is housing. Housing is, although house prices are correcting, rents are still at highs, and we're seeing rents correct in some markets, but rents are still high, putting a lot of pressure on people. Companies that are trying to attract talent into certain areas where housing is expensive have to pay more, which increase costs. The labor market is still strong. The job market is still way more jobs than there are people willing to take them. So that's putting pressure on wages, which puts pressure on prices. And again, this is coming from ARC, which is Kathy Woods' investment fund, her company that manages, I don't know, 14 billion now or something like that. And, again, one of the people that was calling for $500,000 Bitcoin this year, she was calling for $4,000 on Tesla. Just some crazy things in their analysis. And again, they have a bunch of individuals doing the research that she touts and gives away for free that weren't even alive back in 2008 and 9, or even, in the markets back then, or doing anything, much less understanding how all that works. So, a bunch of people doing research that have never been through or experienced anything like what we're going through now, like a 2009, or even really paying attention to what happened in 2018. The only thing they know, and rightfully so, is buy the dip. Fed pivot, buy the dip, markets go straight up because this is Bitcoin here. Let's take a look at the S&P. And let's look at it on a weekly. And I mean, they weren't around 2009, so they don't know what it looks like to go from 2001 to 2007 and basically get back to even. So to go 6-7 years where you've dropped and just basically gotten back to even, and then from 2007 until basically 2013, another 6 or 7 years where you drop just to get back to even. What they know, and the only thing they know, is from 2009 on, raging bull market where whenever the Fed tries to pivot and pull liquidity out of the market, you get a little bit of hiccup from, for about a year or so, maybe 6 months to a year, like in 2014, 2015, and then 2018, a little bit of a hiccup here where the markets dipped about, let's see, that was a pretty good little dip there when the Fed tried to tighten the last time, about 19%. And of course, the pandemic, and then the $2 trillion that juiced the markets and all assets from the pandemic on. But let's take a look at traditional markets here as the Dow is testing this previous low that was set. So currently down from all-time highs right now, right around 25% on the Dow. Our S&P on the NASDAQ, that was the S&P, sorry about that. NASDAQ down right now 35%. So that's pretty good drop. And this is how it happens, right? It just kind of creeps up on you quickly. And the Dow is down 21% currently. It had put a little bit lower below there, but still below those June lows. NASDAQ still below the June lows, testing the latest low last week, and the S&P just above it right now. So critical levels right now, that 3,600 is a big level for the S&P from a technical standpoint. Tested it earlier, found support. So we'll see if that holds up this week into the CPI. And then here's Bitcoin continuing on this trend line. And this is the lower line is the 2017 all-time high. This is the major trend line here. So it broke up out of that, found a little bit of support, broke back down below the 2017 and is finding rejection on the 2017 high. The question is, will it continue down this trend line here, or is it going to continue to just play with this 2017 high and just kind of bounce along till the market figures itself out? One of the things to watch for Bitcoin is the difficulty adjustment just happened today. It's the most punitive adjustment in a long time that's happened to Bitcoin. So a lot of miners are going to struggle with the price being where it's at, energy costs going up as we get into the fall and the winter. There's going to be big energy cost increases there. So that's going to put a lot of pressure on miners. So we'll just have to keep an eye on this hash ribbon indicator and see if it continues, the hash rate continues to hold stable, or if it starts dropping again as miners shut machines off and kind of wait this time out if they can stay afloat. So it's going to be an interesting time for miners. And we'll just have to see as the pressure and competition on the space continues. And again, as we get into the fall and winter with energy prices and things like that. So really interesting times right here at this moment. Even Paul Tudor Jones was out, talking about he believes we are in or near a recession, and history shows that stocks have more to fall. He's thinking there's another 10-20% to go in stocks at a minimum. And of course, he's not hot on Bitcoin right now. He is not. He's probably sold his holdings and is not in there at this point. So these are the things that I am looking at, and I'll see you in the next video.